Investing into areas that bring new medical treatments to market has been brought into sharp focus since the pandemic last year, but spreading risk remains key. We're talking now to Stephanie Sirota, non-exec director at RTW Venture Funds. Stephanie, it's good to talk to you. Thanks indeed for joining us there on the line from New York. How have things changed for the life sciences sector that makes it now so attractive, do you think, today?
Yeah, so I think first of all, we should address the mapping of the human genome and the decline in the cost of sequencing the genome have accelerated the pace of innovation and have unleashed an incredible productivity since 20 years ago when the first genome was sequenced. And this has made it significantly easier to determine the genetic underlying cause of a disease, which has then in turn enabled the viability of genetic-based medicines. So gene therapies and RNA therapies can do things that traditional modalities like small molecules and antibodies simply couldn't. And I think that now we can expect continued productivity and we'll see more targeted therapies that can halt or reverse disease over the coming years.
What are you trying to achieve then at RTW Investments or at the venture fund itself? What is the key for you in getting to where you need to be? What are you investing in? What's the fund shape look like?
So it's a very bottom-up process. Our team is about 50 people, and half of the team have scientific or medical backgrounds. They're organized in a way that they look through one of three lenses. They either look at disease-specific areas, so we have some team members who look at oncology only, or a neuroscientist who looks at CNS and brain disorders. Then we have other folks who look specifically at the modality that's used to treat disease. So we have a specialist in gene therapy. We have a chemist who looks at small molecule drugs. And then the third lens is actually a bioinformaticist and geneticists who look at underlying epidemiology of disease and try to identify what we think are the next viable targets where a drug should be developed. And we ultimately want to do one thing: identify assets that we believe are going to make it all the way across the finish line and into patients' hands. So we're not looking to capture market moves or momentum, but we're really looking to identify what we think are going to be important assets that are transformational to patients.
My understanding is you have around about something like between 25 and 30 core investments within the portfolio that you're offering, which are steered towards capital growth. Do you think this is the optimum number, or as the business develops, do you see you taking on more assets? Is it the idea to encompass more of the market availability, or is it just that you want to stick with that sort of core number?
That's a great question, and I think that the market and the opportunity set is going to dictate what our portfolio looks like. We're definitely not interested in expanding the number of core assets simply to achieve greater diversification. The goal is to be as expert as we can in the names that we own and have a very high conviction that these are actually going to be important businesses one day and sustainable businesses. So we're looking to grow those businesses. And I would say the 25 to 30 core positions is probably the right number for now.
And what's the way in which you return shareholder value? I asked this question in the knowledge that I know that you've recently, I think, floated 3 companies, is that right, on NASDAQ? And I think this is an event that happens relatively frequently in terms of the development of these businesses you bring along. Is that the main and the only way that you return shareholder value? Or are there other ways? Are you able to sustain a business and continue its operational side of it within the RTW funds? Or is it that you normally do sell on and move on?
The intention is exactly that, to stay with a business for the long term. We want to ultimately support businesses that can continue to deliver value. So one thing that's very specific and special to the biotech space, unlike other sectors like technology, for example, is that biotech companies tend to go public very early in their life cycle. So a typical IPO market capitalization is around $500 million. If a company is developing a a multi-billion-dollar blockbuster drug, they could be worth multiples of that IPO valuation. And we want to be around for the full value recognition. I think another important thing to note is that a number of the technologies today are platform technologies that are applicable to a wide range of diseases. And so we're seeing the ability of companies to actually build pipelines within their pipelines and have many more shots on goal. So the value recognition of a company that's developing a pipeline is not going to be fully recognized until years after the IPO.
Let's also take a look as well at how the world has almost renewed its engagement with the life sciences sector, especially biotech. We were talking before we went to air, weren't we, about my experiences as an interviewer. And I was saying to you that I felt that when I was in Boston, Massachusetts, I felt that there was a tremendous market, a tremendous appetite 15 years ago for biotech. Come back to London, and nobody wanted to know. Now here we are, 15 years further on, and indeed on from the pandemic. And I can tell you that I'm getting a lot more people engaged in this sector, certainly on this side of the Atlantic. What is it you're doing in terms of trying to appeal globally? Is there a global footprint for you here, or are you still really centered in the States in terms of the companies you're buying into and the opportunities you're seeing?
So the US has been the leader in innovation, but by no means does that mean that the US owns all of the innovation that's happening. And there's been a democratization of science, and great science is happening around the world. We've had a number of assets that sit in some of our portfolio companies that originated in the UK and originated in labs across Europe. I think ultimately, and one of the reasons that some of these companies get sponsored or acquired by US acquirers is because that's where the capital is. But our hope, and we do absolutely intend to expand our footprint and be local players in the UK, opening a London office later this year. Our hope is to continue to try to foster some of that ecosystem and bring more capital so that companies can develop and stay local.
But you think still, nonetheless, when you list a company, it is only in the States, though, is it? In the NASDAQ, is that the natural home, do you see, of a newly listed biotech or life sciences company?
There is more capital. So that's what the pull is. Valuations are better, and there's still more demand. We're hoping, and we're starting to see it change, but it might take some time.
Yeah, of course, that's what it's all about, isn't it? Returning money and making shareholder value out of all this. Just tell me a little bit more about what RTW does. When you list a company, obviously you take money out of the company and it then goes back into what, RTW Venture Funds, or do you distribute it amongst shareholders? What is the business model here for the investment fund you're running?
It's growth capital, and our model is actually not to necessarily take liquidity when we can get it. So even in an IPO or a situation, where we have a liquidity event, oftentimes we do not only remain invested, but sometimes we use that as an opportunity to invest more if a company has been validated in certain sciences, has been validated, and it rises in our level of conviction for the ultimate outcome of their assets. This is, not going to be a vehicle that's going to return capital or provide a hefty dividend. It's really about growth.
Yeah. So how do you see the next year or so? I mean, we've had the pandemic. How I don't mean to be flippant in this, but how good has the pandemic been for this? First of all, the sector, but also for you as a fund management business.
The silver lining of the pandemic is that it turned a lot of attention to the sector from investors who hadn't really been paying attention or kind of discarded biotech as too specialized, too binary, too risky, not understood well enough. But I think that more and more investors are recognizing that it actually should be part of anyone's portfolio because of the sheer value creation that we expect over the next decade or two. So I think that is the benefit. I think that the pharma and the biotech industry should really try to capitalize on that. I think for our business, it hasn't really dramatically changed our process. It hasn't really dramatically changed the areas of interest that our team focuses on. So it's really been business as usual for us.
Yeah, and what's business as usual now for the rest of this year, and as we look out towards the next full year for the fund
Yeah, some of the areas of biggest interest for us have been our oncology, where we're seeing tremendous advancements there. The brain and CNS, both neurologic and psychiatric diseases, is a growing area of major interest for us. And recently, there have been a number of really important advancements after decades of, not much innovation and a lot of Me Too drugs. Cardiovascular is actually still the largest killer in the United States annually, and we're seeing really important advancements in cardiovascular disease. I think a lot of this is driven by what I mentioned earlier about being able to access genetic information. When you have the code to what is causing a disease, you're able to design a drug that specifically targets the problem, rather than just looking at an organ system and saying, oh, all of this is heart disease. We're now able to refine and understand that there are many different genetic drivers that are causing cardiovascular disease and treat those drivers.
It's very exciting, and it's all power to your elbow, because obviously it means a difference for companies to be invested in to push ahead with these drugs that help us all. Stephanie, we've got to leave it there, but thanks indeed for joining us. Stephanie Sirota is the non-exec director at RTW Venture Fund. For more videos from us here at IGTV, join us on Twitter at IGCom and subscribe to our YouTube channel.